If you think of VAT is a process whereby a business buys goods. So let me just draw an illustration. So we have a business here. Let's say this is the business. It sells clothes. Let's say this is Edgar's, right? So Edgar's sells clothes to me and you, or the customers. So they sell clothes to me and you, the customers. But Edgar's also buys these clothes from a certain manufacturer, right? So you have a manufacturer which Edgar's buys the clothes from, and then it sells the goods to us as customers, me and you, right? So whenever Edgar's goes and buys the clothes from manufacturer, they getting the clothes, but they being charged VAT. They pay VAT to that manufacturer, that supplier, right? And we call that VAT input. So the way to remember this easily, say whenever a business is buying goods from the suppliers, like input means something is coming into the business, like input, it's more of like something coming in. So whenever a business is buying goods from a supplier, then there's VAT input, right? But whenever these goods are leaving the business, meaning that the business is selling these goods to a customer, we call it VAT output. So just use the in and out as your key. So when we say in, we're saying are the goods coming in or out. So when a business is selling goods to customers, the goods are going out, meaning that that's VAT output, right? So they charge VAT output to customers, and that VAT is paid over to SARS. But when they're buying goods, the goods are coming into the business, meaning that it's VAT input. The business is paying VAT input to that supplier, and they can later claim a deduction from SARS. I don't know if that makes sense. Thumbs up if it makes a bit of sense. So perfect. So the answer to 1.1.3 is VAT output. Happy days. 1.1.4, they say in the ledger, a debit or credit balance on the VAT input, VAT output, VAT control account reflects the final amount that must be paid to SARS. Final amount that must be paid to SARS, right? So now they're talking about a certain account which deals with the amount that we must pay to SARS or whatever. So what do we call that amount? Let's start there. So in a ledger, a debit or credit balance on there, do we call it a VAT input account? Do we call it a VAT output account? Do we call it a VAT control account? So we call it a VAT control account. So we don't call it VAT input account. We don't call it VAT output account. We call it VAT control account. And here the question says, so is it a debit or credit balance that reflects the final amount that must be paid to SARS, meaning that we owe SARS money, right? So the answer here is credit. Why is it credit? Let's say, for example, the balance at the end on this account is 2,000 here on the credit side. This 2,000 is the money we owe to SARS. We must pay SARS. Why? Because if it's in the credit balance, think of it, okay, cool, it represents a liability, right? So liability, it increases on which side? It increases on the credit side. If you watched the first video on the course, I think I speak into something called the Ali method, which I always use. Ali method. So it says assets, they increase on the debit side, and then this side is the opposite, obviously. The Ali method. So we're saying assets increase on the debit side, they decrease on the credit side. So the VAT control account, when it has credit balance, it means that it's a liability, meaning that we owe SARS money, right? But if it has a debit balance, it means that SARS owes us money, right? So you think of it more like an asset, that okay, it has a debit balance and SARS owes us money in a way. But think of this account as a liability account, meaning that when we have a credit balance, we owe SARS money, our liability is high, the liability exists. But when it's on the debit balance, it means that we don't have a liability, we don't owe SARS money, but instead SARS must pay us money because either we've paid more to them or something like that. So that's the idea behind the VAT control account. So the answer for 1.1.3 is credit and VAT control account. 1.1.5, an item of stock is purchased for 26,200 excluding VAT. So this is very important, whether something is including VAT or excluding VAT. And then they ask you what's the amount of VAT on the item. So remember that an item is like, let's say, for example, when you're buying an item, the amount excluding VAT is 100%. And then we charge additional VAT on it, which is 15%. And then we arrive at the price which the customer pays or we pay when we're buying from the supplier, right? So when something is excluding VAT, it means that it's 100%. When something is including VAT, it means that it's 115, right? So this is excluding VAT, this is the VAT percentage, this is VAT inclusive. So here they tell you that an item of stock is purchased for 26,200. So meaning that the business purchased stock from a supplier for 26,200, excluding the VAT. So we purchase this thing for 26,200, excluding the VAT. So we use the method. I'm sure you guys have heard of the method, what you want on top over what you already have. So what we have is the VAT exclusive amount, which is 100%, right? And what we want is only the VAT amount, which is 15%. And what do you get? Is 200 times 15 over 100, and then we get 3980. So this is your VAT amount. What do we call this VAT? Do we call it VAT input or VAT output? An item of stock was purchased for 26,200, meaning that the business is buying from a supplier. Do we call it VAT input or VAT output? I'll be waiting for the answer on the chat. I'm writing 1.1.6. VAT input or VAT output? Can unmute if you feel like you're brave enough, But I know you guys are brave enough, so can unmute if you know the answer. Just tell me, VAT input or VAT output?
It's VAT input.
Input, yeah, because the business is buying the stock. So perfect, we're done with that. An item of stock is sold for 39,900. So now you should click in your mind that okay, we're selling stock, meaning that stock is going out, right? We're selling, the goods are going out of the business, so it's output VAT, right? So here they tell you that the VAT is in the amount is including VAT. So you write okay, 9,900 times what you already have, what you want over what you already have. So what we want is the VAT, so it's 15. What we already have is 115, because they say this amount is including VAT, remember. So you get your answer of 15 over 115, which is 520.